Hey everyone, it is Friday. It's 5 p.m. Eastern, and the stock market has closed. The good news is it's not going to open tomorrow or Sunday. So stock prices are not going to fall any further. That's the good news. We'll see how things open up on Monday and Tuesday. It'll be interesting. Maybe the markets need a weekend to kind of chill, and our leadership in the US and other countries get a weekend to try to figure this thing out. Hopefully, they figure out how we can proceed forward without a bunch of tariffs that are going to tank the economy and blow up the stock market. The extreme fear gauge. This thing's published by CNN, and it's been moving. You can't go past zero. Guess that's the good news. As we look at the fear gauge here, it just won't go past zero. We're down to 4. And a couple of things I wanted to draw your attention to is the previous close, we were at 7. All right. Yeah, it was pretty scary a day ago. But a week ago was 21. 21 we were still in extreme fear, but not quite as bad as it is now. And then a month ago, we were in the fear zone, extreme fear zone. A year ago, we were neutral. We were like up here in the neutral zone a year ago. So it's been a really rough week. The market's just tanked today. The NASDAQ was down 5.82%. The S&P was down 6%. Dow down 5.5%. And we've officially gotten into bear territory with the NASDAQ down more than 20% year to date. We're actually from the high to where it's at now. And that's just really rough stuff. It's not easy to consume and deal with, but I would tell you that, this is stock investing and we're going to have volatility. And if you've lived through these and you've invested in these, you realize that this might be a really good opportunity. So hang in there and keep doing what you're supposed to be doing with your investments. Analyze the investments. Make sure you really believe in those businesses. You understand the story of that business. Why is it going to be successful over the next couple of years? Does it have a better product? Does it have better services? Does it have really good free cash flows? Is the intrinsic value of those cash flows much higher? So we got to keep getting back to the fundamental analysis and believing in these businesses, because as you can see, stock prices could move very quickly. You see stocks on big stocks like Apple, it's getting smashed. I can go down the list of the top 10 stocks. They're all getting smashed. And that's not based on, fundamental analysis. That's just based on emotion. Investors just selling out, trying to get out. So for me in my portfolio, I'd like to use this as an opportunity and buying these great companies that I think are terrific companies and buying into the storm, really focusing. Now, what tends to happen out there, and this is the general kind of population, okay, general people, I should say, hardcore investors, as many of you are, so don't take this the wrong way. When times like these get rough, they just go away. They're like, oh, I don't want to deal with that. I'll let my financial advisor deal with it. Or I just want to ignore it for the next couple months until the situation's better. Well, in my opinion, that's absolutely the wrong thing to do. Now is when we have to take action. Action in the form of, okay, what are the stocks we should be buying? How do I create more cash? How do I create more dry powder? Can I get out of some bonds and get into some dry powder? Can we, and it looks like Kevin Baird, new member. What's up, man? Good to see you. Thanks for joining. And so now is the time to take action. It's not a time to freeze. And again, you guys I know some of you, and you guys are hardcore investors. So let's do this together. Let's remind each other. This is a time to make money. It's just, you don't make it immediately. You make it over time. but it's a great opportunity. We've been talking about some of these companies for a while, and we know these businesses are good. Now we're getting offered an awesome discount. So let's do something with this crash. I'm streaming here on a Friday. If anything, I feel better if I'm doing something about it. I've been trading. I invested in a good string of stocks. I'll show those a little later today. I bought a bunch of stocks yesterday. I'll show you where I'm selling in order to create cash. And I'm also going to show some super investors and show you their year to date. So we might be feeling a little like exposed, like, damn, I've just lost a lot of money. Yeah, but let's look at some of these super investors and you'll see that they are mortal as well. All right. So Kevin Barrett, really appreciate you joining as a new member. Looks like today has been a good day for members. You're one of 3 new members, and be sure that somehow you don't have to do it on the chat. You get me your email address so I can invite you to other events and get you access to the tools that members get. So thank you so much for joining. Appreciate it. All right. Looks like Mike, the dividend investor guy, is on. How you doing, Mike? At the end of yesterday, I dropped in the negative year to date. I can honestly say today was bad for my portfolio, but hopefully one day I can say, man, I wish I could have bought more. I think you're going to live to that day. I think some of these stocks, are just getting smashed, and it's not like there's a reason for it. They came out with a bad product and they're getting smashed, or a competitor became stronger and better and they're getting smashed. A business deserves to be priced differently if they fundamentally changed. If they changed and it's a weaker business, that's one thing. But across the board sell-offs like these, they tend to obviously sell off very fast, and it takes a while to get back to its previous stock price. But that's an opportunity. If the companies did not change overnight, they did not get 20% worse. Over the 2 days, some of these stocks have gone down like 15-20%. So we'll take a look at a few examples, and I'll let you know what I'm doing with these stocks. Looks like Hugo, good to see you. And that's oi oi. I'm not sure what that means, but good to have you. Brian Silk, how are you doing, man? So Hugo, you'd like to talk about Verizon, VZ. All right, we'll take a look. And just bear with me. I'm going to go through some comments and I'll come back to you. And then we've got Shadwick. Good evening. GameStop. Man, today, I wonder how GameStop is doing. I'm curious because everything's getting smashed so bad. It's pretty much GameStop. I'll laugh if it did better than, let's say, an Apple. We'll take a look at that later. So Mike got to run. Yeah, sounds good, Mike. Have a nice weekend. All right. So Kevin, be interested in your thoughts on MongoDB. They announced a stock buyback, strong earnings. Yeah, let's look at Mongo. And we looked at Mongo about a week or 2 ago. So it's kind of a little fresh on my mind, but we'll do a full analysis. We'll look at the company. We're going to look at their cash flows. We're going to look at their earnings, and we'll just go completely around that company. And we'll get to what I believe will be a reasonable intrinsic value for Mongo. Carlos, good to see you. Yeah, don't be the guy that says, I wish I would have bought the tariff dip. Exactly. And if you think back at when the COVID days, right? That was such a weird time. This virus came out and I'm like, I was kind of in disbelief. I'm like, really? Is this thing really going to be that bad? Or is it just like a really bad flu? Then they shut down the economy. I'm like, whoa, the stocks started just sell off like crazy. Some stocks just got murdered. And very quickly they came back. And I feel that we're entering kind of a situation like that. I'm not going to say it's bad because, with COVID, there's people dying and stuff. So that was a lot worse. So, uh, but it does feel like kind of like that a weird kind of situation. We have these tariffs that came up. I thought they were kind of priced in that we were going to have some tariffs, but once they were announced and the numbers were presented, the market really just freaked out, and here we are. So, Mohammed, good to see you again. I don't have a valuation on ANET. We looked at it in the previous couple of days, but we'll take a look at that. And then GameStop is up 11%, huh? That's funny. That is really hilarious. Garrett, you like Celsius? All right, take a look at that. So Celsius. And then Gentleman X, how you doing? Good day. Shadow Guy. Oh, okay. Oi, oi is hola, hola in Portuguese. Cool. Thanks for interpreting that for me. Very good to see you, Portugal. All right, so let's get started. We're going to get started on the MongoDB request, and we're just going to jump into it. We'll come back to the market. We'll come back to super investors and my buy list in a little bit. And so MongoDB. So MongoDB, as you likely know, is a company that's come out with a database that's kind of a new generation of database. And the company hasn't been doing great. The stock year to date is down 34%. A couple of things that are, I think, the reason for the sell off is their revenue isn't incredibly high growth, right? It's 19%. If we look at the quarterly, 19.74. That's not bad. And let me double check. I know we looked at Mongo, but I don't know if I did a full valuation. No, I didn't. But we can do one. We'll create one. We'll compare it to. Let's go compare it to Salesforce. So MongoDB is a software company. They develop a database. They're a $12.5 billion market cap company, $2 billion in revenue. So investors are paying a little over 6 times revenue for the company. Forward P is 57. And their growth, 19%. They've got free cash flow of 120 million. And they just, they started to become, I think, profitable. No, they're still not profitable, but they earn free cash. So that is an important milestone for them once they start producing free cash flow. So that's good. So $120 million of free cash. And then we've got on the balance sheet, they have $2.34 billion of cash and just a little bit of debt. So $2.26 billion of cash. Okay. So that looks good. The balance sheet's really strong. The cash flow is a little light. Now, what happens with businesses is that they keep getting bigger, right? And as they get bigger, they get more efficient. They don't have to buy, the same machines and so forth, or maybe servers when it comes to a MongoDB. Once they built their infrastructure once, they don't have to build it again, and they can scale up and become more profitable and create more cash. So when we look at Mongo, we'll do a valuation, and I'm expecting that the cash is going to grow quickly. So let's jump into a valuation. This is the schedule here. Again, get me your email address, and I'll be sure to get this over to you. A working copy of it. But what we're going to do is we're going to create it, from scratch. And first, I want to copy it because I don't want to erase my Salesforce work. All right, so and what is the symbol on Mongo? It is MDB. Okay. So MDB. Now, Salesforce gets a discount rate at 8%. Mongo is a smaller company, so I'm going to go to 8.5. And interest rates are falling. When we hear about interest rates and what do they have effect on stocks? Remember, stocks are the principal valuation method that most investors, professional investors, hedge fund managers use is discounting of future free cash flows. And that discount rate is an interest rate, an implied rate of return that an investor wants. Since rates are going to be dropping, and they dropped substantially over the last 2 days, I'm going to begin to adjust my discount rates as I see interest rates fall. A week ago or a month ago, I would have used the 9, but I'm going to go with 8.5 on Mongo today. So the free cash flow was 120 million. So what I'm going to do is I'm going to take 120 and I'm going to grow free cash flows by 25% in the first 4 years, because the company established their scale, and now that they're bigger, they're just going to be more efficient. And we'll go with 25% growth. And the intrinsic value of all these cash flows, if we take $120 million is a trailing 12-month free cash flow. And the first period here is really looking forward 12 months. So over the next 12 months, I expect that number is going to grow by 25%. So the cash on the balance sheet was $2,260,000,000. And that was net of debt. So I don't have to put a debt number. Now, shares outstanding. Let me use Google on this. All right. So the market cap of the company is 12.5 billion, and it results with a 30% premium because the cash flows aren't very high. And the growth rate isn't incredibly high. It's 19%. If it was growing like at 250% or something, then you could really get more optimistic. But at a 19% growth rate, that's as far as I would go with the cash flow. And you could see that, hey, the company doesn't value very high. Now let's take a look at earnings per share. So the earnings per share for Mongo, analysts, they think very highly of it. And one analyst thinks it's a $440 stock, 215. We're in the fiscal year of 2026 since their year ends January 31st. And they're expecting $2.61 earnings per share. Okay. So 261, very high PE. I'm going to go with 261, and I'm going to give them a 25 PE. So 261. So you can see that the valuation isn't getting anywhere near its current stock price. When you think about Mongo, they are competing against some really tough competitors. They're going to compete against Microsoft as an example. Microsoft has a big database business. They've had a database business for a long time. It's really hard to compete against those guys. So they're going to have a little bit of an uphill battle as they go to market. And the market's not receiving their database, with open arms. If they did, they'd be growing at 80% or something. 20% growth is good. Keep in mind, now software is always sold under a subscription and you get to raise your price over time. So a good part of that, 20% growth rate is an increase in price. So it's not necessarily greater market share capture from Mongo. So overall, looking at Mongo, it doesn't have an attractive valuation. And it's always a matter of looking at a company and comparing it to other companies that you can get in that industry. I like the software industry. I think it's a real good industry, good profits, good cash flows. But let's kind of take a tour across a couple other companies like Salesforce. Salesforce drives great cash flow, tremendous cash flow. Look at the cash flow difference. Of course, their valuation is much higher and their market cap is much higher. But you see the example of, boy, they got really nice cash flow. And Salesforce is growing quite well. Mongo is as well, but Mongo is much smaller and they should be growing at a higher rate. The other company I'll compare to Mongo is DocuSign. DocuSign's done well, and you likely know what DocuSign is. They do signature capture. It's a software company, and they drive a lot of cash. Okay, much higher. Mongo is at like 120. These guys, with a growth rate of 5%, they're at 967. So they provide a nice discount if you look at their cash flow. And they've done well. This stock has appreciated well over the last 12 months. DocuSign's growing at, I think, high single digits, 10% or so, but they're really profitable. DSP, another example. These guys do software in the marketing side where when businesses are trying to advertise with new media like Facebook and Instagram, YouTube, and so forth, you use platforms like DSP or App11. And this stock, it's really priced down and provides a really nice discount. The intrinsic value of a company, going back to Mongo, the intrinsic value of a company is the value of its cash flows in the future, discounted at a discount rate that the investor wants to put in. I put in 8.5. That's the number that I would stand behind. And this is the intrinsic value. This one is trading above intrinsic value. So we went over this last week or so, and that's the conclusion we arrived at. It's, there's some businesses where people really believe in the company. And I'll show you Palantir. Palantir is the value, the stock price, right? It's been on an incredible ride. I believe they're priced too high when you compare their cash flows and even giving them really good growth. I think the valuation of the company, they're worth about 90 billion, but their market cap's 173 billion. So some stocks just take off and the market loves them and they really win the hearts of the market, I guess. And Palantir's certainly been that company. App11 was on that ride, but their stocks really come down. So as you can see, software, I look at a lot of software companies. You're looking in the right space. Software is a great place, and software companies are getting discounted right now. The last 2 days, the technology space has gotten really decreased in price and providing much better discounts. So that's my analysis on Mongo. And again, it's there's a lot of other software companies that I think really stand up tall, and this one here isn't quite at intrinsic value. So that's my analysis of Mongo. Yeah, anytime. What I'm going to do is I'm going to save this guy, and then I'll publish like all the companies that I analyze. I'll publish them once a month, and you'll have access to this, and you can look it up and anytime you want. All right, give me a second here, guys. I'm going to do a little data entry. Not the coolest thing to do, but that way I don't forget. All right. That way I don't forget and I'll come back to it. All right. So let me catch up on comments here and then we'll keep going on request. So caught up with GameStop. Sounds good. We got Celsius. And then Shodwick. Interesting. So GameStop CEO bought 500,000 shares. Interesting. Cool. So JZev, you bought some Amazon, some Meta, Google, Microsoft, and SCHD. Interesting. I picked up some Meta yesterday, some Google yesterday, and some Amazon yesterday. So yeah, the prices were really coming down. And then, hey, Chris, hello from Germany. Very good to see you. Thanks for joining. You want to look at Grab, and this is Cam 83. Yeah, I'll put Grab on the list. All right. So let me show a couple of things that I wanted to show as an opening. I saw that a member request came in, so I wanted to jump on that. But I wanted to show you that, yeah, the market's down. But, you know, I'm going to show you what super investors are doing, because I do look at super investor portfolios, and I've been, doing some of the homework to see where they're at year to date based on their holdings. The NASDAQ is down. Let's go to this recent high. It's down 22%. Wow. And it's happened fast. That's the other concerning part, is it happened really fast. All right. So when I look at super investors, and I was trying to finish this list before the live stream, but I didn't get there. Pat Dorsey, his portfolio, he's a really smart guy. He's down 19% year to date. Michael Burry, he's beating the market. The market's down. I think the S&P is down 13.6% year to date, not from the high to the low, year to date. And all these numbers are year to date. So Michael Burry is just having a heck of a year, considering he's close to even year to date. Warren Buffett's pretty much close around the S&P, and this just really measures the stocks they own. I know they have cash and so forth, but I'm just measuring the stocks they own. Howard Marks is pretty close to the S&P. Bill Ackman is down 16%, and the S&P is 13. Kathy Wood down almost 32%. Wow, that is a big loss. Why hire a professional money manager if they're going to lose 32%? Year to date, that's just 3 months. Ouch. That is rough. And I'll get these done, and I'll show these on a future video or live stream. But the reason I wanted to show those is, yeah, our portfolios are taking a hit. I'm down 10% right now. I'm down minus 9.99%. So I'm beating the S&P, but I just wanted to show that even these great investors are taking a pretty good hit. With the exception of Michael Burry, everybody else is pretty much in the same boat. Kathy Wood's in even worse shape. So it is just what's happened, right? It came up on the market quite quickly. I thought that we had these tariffs priced in, but we didn't. And if you look at the impact on the market, wow, the biggest stocks took a pretty good hit, and small caps are getting, really, really punished. When we look at sectors, I mean, just a week ago, we probably had, 6 out of 11 sectors, in the green, doing okay year to date. Now only staples are in the green and barely hanging on. Utilities are barely in the green. Healthcare is in the red, but you look at technology, it's deep in the red. When markets sell off, they tend to sell off the small caps with just a lot of momentum, as well as, certain sectors like technologies just getting sold off. And that's where the opportunity starts is some of these stocks are going to be unfairly priced down. And if I don't own them, that's an opportunity. Awesome. Buy into them at a really good time when they're being discounted so much. Then when the market realizes it may take 6 months, may take 2 years, the stocks rise and they rise and go past they go up to their intrinsic value, but oftentimes they go past it once they catch momentum. So that's the opportunity that I think is out there now. Probably 3-4 months ago, you heard me on this channel saying that stocks were expensive. It was hard to find discounted stocks. I'm not saying that anymore. I'm seeing discounted stocks in software, even semiconductors. There's some semiconductors that look really nicely discounted. So it's really brutal out there, but let's keep doing our analysis. Let's have a good game plan and take advantage of this. The big caps, looking at Apple, it was down 7%. Today it's down 24% year to date. Microsoft isn't doing as bad as Apple. It's down 14%. Nvidia down 30%. Amazon down 22%. Google's down 23%. Meta down 13.8%. Berkshire is down 9%. Tesla is getting destroyed, down 40%. Incredible. And then Broadcom, I have been saying that Broadcom is really valued far less. And I've been saying that for a while. And it's beginning to really correct fast. So when I said some semiconductors discounted, I was not referring to Broadcom. I was referring to others. So that's what's happening out there. All right. So Omar. So you're saying that you're running out of cash. Well, Omar, get creative. Got to get creative to create some cash. And, I think it's a good time. I think right now, if you can create more cash for yourself, it's just a really good time to buy stocks. So I know it's tough because oftentimes we want to be invested. So maybe we carry 10% cash, I don't know, 5%, 15%. Then events like this happen and your dry powder goes really fast because you're buying so many different stocks. So, but get creative. I'm sure you can figure something out. Maybe work a little more, contribute more, spend less, have a nice tight budget in whatever you do and invest better. All right. So looks like Cam. Some ideas, XYZ, 4, and then S. I think S is Sentinel-1. Okay. Good ideas. All right, let's go into this list. The first one on the list is going to be Verizon. So Verizon's been doing okay. It's up 7.6% year to date. It had a bad day, but yesterday it did well while everything else was really going down. It's an $181 billion market cap company. Revenue is $134 billion. And it has a low PE. The thing I dislike about Verizon and AT&T is their balance sheets. When you look at their balance sheets, they have a lot of debt. This one has $171 billion of debt. Okay. Once you deduct the cash, you have $167 billion of debt. That's a lot of debt. The market cap of the company is $181 billion. So whenever I do a valuation on these, it just doesn't come out right because you have so much debt involved. I always deduct debt away from the intrinsic value of those cash flows because the first thing you would do is pay off debt. And once you pay off the debt, you're left with very little cash. The company isn't growing a whole lot. It's a slow grower. And they do drive free cash, close to $20 billion. But But again, if you take 20 billion, slow grower, and you go, okay, well, maybe that cash in itself is worth about 200 billion if I multiplied it times 10. First thing I would do is deduct the debt that's has to be paid, which is 160 billion, and it leaves me with $40 billion. Well, way lower than its market cap. So although these are working because this is a very stable industry, right now, when we have the economy's headed toward a recession, tariffs are not going to touch Verizon or AT&T. It's not like there's going to be tariffs on our mobile phone service. And in this case here, this stock looks good to hold. But when you look at the valuation of the company, to me, it just paints a different picture, which is that debt's a big problem. Debt is not good. It's evil. It's bad. Their debt to EBITDA, I think there's a debt to EBITDA ratio is 3.15. That's higher than what I like to carry. But when I do my valuations, you saw me deduct deduct debt from the MongoDB valuation. I'd have to deduct that debt, and it brings down the valuation of Verizon. So for me, Verizon and AT&T, they're sells. I just don't like how much debt they carry. It really takes a lot of the value off the table for me. The stocks are working, but my approach on investing is I want to own stocks. If you buy a stock and already have an exit plan, that's a good idea. Like I bought Zim in 2024, had an exit plan, executed that. That was fine. And on Verizon, it would be, if you bought into Verizon, it would be for me, in my mind, it would be kind of a short-term gain and then get out, because it's not going to be a good long-term hold. It just won't appreciate a whole lot over time. Over 5 years, Verizon's down 21%. This is what I mean. The market just is going to look at that debt, and especially when interest rates are much higher, that debt became such a problem. Now that interest rates are going down, the market's relaxing a little bit around Verizon and AT&T. Hey, Tomas, how are you? Welcome to hell. Yeah, I heard an economist of all people from, what was the firm? It was, I forgot the firm, but he said that we have arrived to purgatory, and if it gets any worse, we're going to see what hell looks like. I'm like, wow, man. I guess some people are taking it harder than I'm taking it. I see that, hey, yeah, it's pretty bad out there, but hey, I'm just going to keep investing, and I'm going to keep moving, and I'm going to be fine. I think, like somebody said earlier, we'll look back 2 years later and go, whoa, remember that? Remember the beginning of 2025 and stocks were just getting smashed? I think that's what we're dealing with. So good to see you, Tomas. Let me know if there's something you want me to cover. And looks like Philippe Pais. You want to look at CEG? All right, I'll put it on the list. All right. So we're going to hit GameStop next, but let me just draw your attention. Love for you to be a member of the channel. To get there, you go to my homepage on YouTube, click this guy, and you can see the different options. And I think you'll be a greater part of the community. You can communicate with the community far better. You can get on the Discord. You have access to the tools that I use. And we also have some calls 3 times a week, 2 on the weekdays, 1 on the weekends that you're invited to. So take a look. It'd be good to see a lot of you guys join and have you participate in the community. All right, so let's take a look at GameStop. So GameStop did go up today. Incredible. And over the 5-day, it looks like it's up 11%. Most of its gain was today, 11%. Now, this is a small cap, I believe, super small cap, 10.5 billion. And they've been trying to do some things that I think are kind of gimmicky. The gimmick was they're going to start buying Bitcoin and try to do what MicroStrategies did. And I guess they call themselves Strategy now. And I'm like, man, if you're into Bitcoin, buy Bitcoin. Why would you buy a failing retailer that has been troubled for a long time? I mean, I like GameStop as a company. I have 2 sons. I spent plenty of money at GameStop buying my son's games there, and they had fun playing video games. So I like what they sold, but the market changed. The games are being downloaded. Games are being played online now. You don't need to go to a GameStop to buy games. So their business model has pretty much been disrupted, and they didn't evolve quick enough. They didn't change quick enough. And now it's kind of a dead business. That's I wouldn't own GameStop as a long-term hold. I think some people trade it. Of course, it was the big short stock. The shorts ended up winning in the end, but in the beginning, or I should say, the people who held the stock, who squeezed the shorts, did do well. Some of them that got out, and some people stayed in too long, and then they ended up losing most of their investment. So this guy here, for year to date, it is down 25%. The 5 days doing okay. Market cap 10.5 billion. Very high forward PE. Revenue has been declining for 1, 2, 3 years. Now they caught, I think, a revenue increase in 2022, but you see in the last 6, 7 years, you have decline. 1 year where they grew, and then the other years it's just been revenue's been declining. That's a sign of a business that's struggling, on its way out. Do they make money? Looks like they are profitable. They do generate a little bit of cash flow, but it's a declining business. So I would multiply this times maybe 5, 10 to be generous, and we'd get to like $1 billion of value, but they're priced at 10.5 billion. Looking at their balance sheet, they do have more cash than debt, and I can explain why. Is when their stock price was really high, they issued out stock, and they issued it out, and they were able to accumulate some cash. And I think that's what's keeping the business active, is they did that. Now, when you do that, you're liquidating the company. So the stockholders pretty much let the company dilute the company. But that's what happened during the short squeeze, is the company generated all that cash. Nonetheless, these guys are pretty much just hanging on. Their business really isn't relevant anymore. And now they're coming out with these gimmicks of, hey, we're gonna go in the Bitcoin business. So this isn't a business that I would be investing in. I'd be staying away from it. Probably just be distracting. It brings me to something I did want to cover, which was, to my surprise, Bitcoin went up a little bit. Let's take a look at the monthly. So this is the monthly chart. And we've had this drawdown over the last couple of days. Bitcoin didn't see it. Interesting. And Bitcoin is, if anything, it gets categorized as a high risk investment, but it didn't go down. So I was surprised by that. It held together quite well. I own Bitcoin. I own more than one coin. I own, I think, a coin and a half. And I also own Ethereum. So it's one part of the portfolio, along with bonds, that held it together and didn't go down. So I thought that was interesting. Bitcoin really held together. Huh. Okay. So back to analyzing stocks. Let's take a look at, so ANET has come up again, and Arista Networks. Oftentimes, a good company with a good product, it captures a lot of attention, a lot of positive momentum. You see this chart for Arista. What a beautiful chart. The only problem is this is not sustainable. Okay. The stock 2 years ago was a $28 stock. Now it's at 64. And it's up 348% over a little over 2 years at the peak. And then more recently, they had earnings announced and they really have sold off by 50%. Now, some investors might be thinking, hey, is it an opportunity to buy into this great business? And my answer is no. And I'll explain why. So I think it is a very good business. Arista Networks started in networking, but they do security. It's a very good business. But let's take a look at their fundamentals. And I'll point out that I think it's overpriced. And now you could see that investors realize, we're not buying into fundamentals here. We're buying into a popular stock. So the stock's down 50% over the last month and a half or so. Revenue growing at 19.5%. The last quarter grew really nicely. In their earnings, the management team guided that growing in 2025 is going to be tough for them. It's going to be harder than it's been in the past, that they see a softness in the business. And that's what led to a big sell-off. When we look at the growth is good at 20%. Gross margins are at 64%. Looks good. Free cash flow, $3.6 billion. And when you look at the market cap, 3.6 billion, not too long ago, this market cap was 50% higher. It was up at around $120 billion in market cap. And the 3.6 billion growing at 20%, if I multiply that times 20, I get to about 72 billion. So the stock's still a little overpriced. It has a lot of momentum to the downside, and it was never worth the $120 billion. When I valued the company, when it was priced at $120 billion, I called it out and said that stock looks really expensive. I made videos on Arista and put them out there. A lot of people did comment on those videos that they didn't understand why I didn't have a higher valuation. But that's what I was seeing is their free cash flows cannot justify that stock price. And even at their current market cap, the current market cap's still a little expensive. The intrinsic value is lower. Looking at their balance sheet, they have $8 billion of cash. So it's probably closer to fair price now, but I wouldn't be buying a company at fair price. I want to buy it at a discount. I want to buy a stock that's really beat up. I'll give you an example of a stock I'm buying into that is a very risky venture for me. Look at this chart. Holy smokes. It really went up. This is Astera Labs. This is a semiconductor company. And I'm buying into semiconductor again because the small caps are just getting smashed. This company, not too long ago, was $145 stock. Now it's down to 52. And this stock came up in a live stream. And I'm going to get back to Arista. This caught my attention. 242% growth rate, 45% before then. These guys are in a part of the data center that makes a lot of sense for growth. And they're tiny compared to like an Arista or even a Cisco. So that type of growth really caught my attention. They have free cash flow and they're profitable and they have good margins. Margins are at 76%. That looks really good. But they're being really, their stock is really getting hit because of the whole sell-off. But small caps are gonna get their stocks further discounted versus the really well-known names like an NVIDIA. But when we study a business, and I did dive a little deep on this one, I really like these growth numbers. And I look at the product they produce, it's really fits the times. It's a very important product for data centers. So instead of buying in a Arista Networks company, which is going to be fairly priced, I believe Astera is highly discounted, and it has incredible growth, and it has cash flow, and it has profit. So this is, to me, a better opportunity, much better upside potential as opposed to Arista. When is it going to stop dropping? It already lost the confidence of the market, and now it's going to trade kind of like as a value stock. Where this stock here, once it stops falling and investors realize this thing's a real growth company, they're going to really bid it up, or they get acquired, because this business is really interesting. It really, they're selling a lot of their microprocessors for the data center. So that, compared to Arista, I'd rather buy Astera, which I've been buying, but it's been a tough deal, man. Look at the 5-day here. So I'll go here. So the 5-day, they're down. No, they got to be down more than that. 8.9. So this is yesterday. Yeah, down 14%. And then today they were down 5%. So yeah, collectively they were down like 20% over 2 days. But they've really been going down, and I'm a dollar cost average investor. So I see a business. This business looks really good based on fundamentals. They're growing really well. They're profitable. They're generating free cash. My intrinsic value is much higher than the current stock price. The market's selling off semiconductor. That's no secret to anybody. The market's like, oh my God, we got caught with, too many shares of Nvidia and Broadcom. Just get rid of all semiconductors. And they're throwing away really good companies like Astera along with that approach. All right. So that is Arista. Somebody asked about Celsius. So let's take a look at Celsius. So Celsius is a beverage company. I think they rallied recently. Here it is. Wow, look at that. That looks really good. And I think they started to grow again, and they had some good news. They've continued to grow. Although look at their growth, it really slowed down. Actually, they've been contracting in the most recent quarters. They were growing really nicely, but one of their main competitors formed a partnership with one of Celsius's biggest distributors, and took certain market share away almost automatically. And that's what really hurt their revenues. So now they're trying to find ways to grow again. And it looks like they're making some progress, but they're still not growing yet. Interesting. So they are a $1.3 billion revenue business. Free cash flow is at $240 million. Margins are at 50%. It's not growing right now, so I think the business would be worth about $2.4 billion minus debt. And they have cash of $890 million. So they still have cash of about $870 million. So the business would be worth what I said, 2.4 plus that 850 million or so. So that gets us up a little north of 3 billion. But their market cap's 8.36 billion. So I'm not interested. They're not growing yet. It's like they have ideas, they have plans and so forth. Great. Now, oftentimes these businesses, right, they had these growth years, and investors expect, well, they're going to get it together and they're going to start growing again. And they may. But I would just say that when you're little like this, they did successfully launch their product, get a lot of attention, and they grew very fast when they were little. But now that they're bigger, some of the big established players like Monster was the one that took them out of certain markets. Red Bull, those are really established brands. Those are going to be really hard to compete against. It's kind of like competing against Coke or Pepsi in their particular energy drink market. So this one here, I don't know that they're going to ever get back to high growth. They may be sitting on single digit growth for a while. And based on their cash flow, they're just not worth what they're being valued at. So that's my observation of Celsius. They did catch a rally. I did notice that. But I think if we look at Celsius long term, I don't think it's been a pretty picture. The 1 year it's down 55%. It did have a really nice rise when it was growing really fast, and then it just collapsed. So from the very top to where they're at now, it's down 63%. So it's been a painful ride for anybody who's stuck around. You love the stock on its way up. If you stayed around too long, you lost a good part of your investment. So it still went up a lot. It looks like it IPO'd somewhere back here. It was $1.50 stock. Interesting. So that is Celsius, the beverage company. Hey, good to see you, Sergio. How are you? You like Micron dropping a lot. Yeah, semiconductors getting smashed. We'll look at semiconductor. Let me catch up and then we'll look at semiconductor. I've been wanting to do a video looking at all semiconductors of the space. So I'll kind of go through and kind of we'll tour semiconductor in a bit, because at some point it's going to be a really good opportunity. It's been selling off for 6 months, maybe 9. And at a certain point, the market's just going to go too far in the negative direction. And I'd like to understand which companies are going to be good to buy and hold. I've done well in semiconductor. I made a lot of money on TSM, holding it for a while, and then selling at the right time. And then Broadcom, I made good money on Broadcom, buying it at the right time and then selling at the right time. All right, so we're going to go over, I think somebody wanted to see Grab. All right, so Grab. Okay, so this is the super app company in Cambodia, Indonesia, Malaysia, Myanmar, the Philippines, Singapore, Thailand, and Vietnam. It's down 12% today. It's down 21%. Looks like last few days have been really miserable. Now, this company, I believe that Uber owns a part of them, and they have good growth. Now, I was seeing, I think, a lot of enthusiasm behind this company, and I was like, okay. But when I look at their revenue growth, I'm like, well, they're not growing very fast. I mean, it's not, this is US dollars, right? US dollars. And they're not growing all that fast. They're growing at 18.5%, 17% for the most recent quarter. So it's not like, wow, man, this is incredible growth. No, it's good growth. I'll give them that much. But Uber is growing like slow teens, but Uber is massive, way bigger. And they're still growing really well. So the growth is okay, but not great. $775 million of free cash. And they just started going free cash flow, which is very good. Excellent. Margins are okay. This is a service provider. It's not like a software company that's an 80% margins or pharmaceutical at 80% margins. These guys provide a service, so it's going to be lower. And when we look at the valuation, let me see how much cash they have. So they have $5.68 billion of cash. So they have $5.3 billion of net cash after debt. So they do $775 million of free cash flow. So if I took that number and multiplied it times 20, I would get to about $15.5 billion of value. I add the cash on the balance sheet, we get up to $20 billion of value. And this company is priced at $15 billion. So this thing is discounted. It's discounted by about 25%. So it's an opportunity for somebody. Now, this is an international company to me. I'm in the US. So it is discounted, but does it offer enough of a discount for me? And my answer is no, not yet. There's other companies that offer really good discounts in that space, right? Uber being the biggest one. Let's take a look at Uber. Uber is wildly discounted because of the stories that robotaxi is going to replace them and all that stuff. But they drive great cash flow, good growth. Uber, that's where I'm invested. Lyft offers a huge discount. I mean, these guys are discounted. So when it comes to the Grab stock, they don't provide the same, risk reward ratio. Look at Maple Bear, which is Instacart. Far better, cash flow to market cap. And these guys are discounted. So when I look at a stock, I want to see within their immediate industry, which is the best opportunity, right? And right now, I think Uber is the best opportunity. It's definitely going to be the winner in the space. It's going to take a lot for anybody else to compete against them. They have the network power. They have that moat of the network. They're very well recognized. They make great money. They drive good cash flow. So Grab is interesting, but Uber is the stock I'll go with. And I believe Uber does own a part of Grab. So when you own Uber, you own a little bit of Grab. So thanks for asking about Grab. I think somebody wanted to talk about CEG. CEG. Constellation Energy. What's been going on with this one? So the data center got a lot of people riled up, a lot of interest. And utilities got a lot of interest because, we're going to need so much power for the data center. Let's see what's going on. Whoa, look at that chart. Oh, man. So utility companies, in my opinion, are terrible businesses. And I'm going to show you why once we get to their financials. But look at that. Oh, man, that is hard to stomach. From its high in 2025 to where it's at now, it's down 50%. Ouch. Now, the story was, well, we're going to need so many data centers and we're going to need power for those data centers. So the utilities are going to make so much money. Okay. Maybe, but utilities don't make a lot of money. They barely make any money. And they have to spend so much capital in their businesses. I just don't like those businesses. So let's take a look at the fundamentals and I'll show you what I don't like. I've never liked about utilities. In a way, I feel bad because I just pretty much tell you what I think. And sometimes I feel like I might be offending somebody, but let's get into it. $53 billion market cap. PE 14, forward PE 18. Okay. Utilities usually have a PE of like 8, 10. They're really low PEs. Now, investors got mesmerized by the data center ideas. They're like, oh no, we're going to start pricing them like growth stocks. Well, I'm not going to agree with that. Now, the data center is supposed to be growing like wildfire. But these guys are not growing. So if the data center needs so much more power, how come these guys aren't growing their revenues? That's the first sign that, hey, the story is not matching the fundamentals. The fundamentals are showing me that this business is just stagnant. It's actually contracting in the most recent year by 5%. So that's a problem. Now, when we go free cash flow, there is no free cash flow. Let me show you why. Utilities have to spend so much in CapEx. Here's capital expense to think about like their power generating equipment, and they have to like buy parts, replace parts, kind of refurbish all this generation equipment that it takes all their profits away, and they have to put it back into these machines that create power. Well, that's not a good business. I'd rather have Facebook. They charge to advertise on Facebook. They make lots of money, has high margins. They get to keep all the money. They put that cash on the balance sheet. That's the business I want. I don't want a business where they work really hard, they generate profits, and they have to put them back into the power generating plant. That's what utilities are. And that's why I don't like these businesses. And that's why I'm like, yeah, somebody else can invest in this. And I'm so glad that I did not invest in it, because somebody's getting crushed. This is brutal for some investors. The business behind this stock is, in my opinion, undesirable. Let's go to my desirability. So here we go. So what's the desirability of a business? So let's go over a really desirable business first, and I'll tell you why that business is really desirable. And then we'll go into this utility. So we all know what Meta does, right? So Meta is a social network company. When we look at their financials, it's just a really valuable business. Let's take a look at their financials, and then I'm going to put them into the quadrants here. So we just saw utility, and they have to put so much money back into the power generating equipment, right? Meta is a $1.28 trillion market cap company. It's done really well over the 5-year. It's having a bad year along with everybody else. But when we look at their forward P20, but let's take a look at growth, 22%, and they are a monster company. They're massive. That's why when I look at MongoDB that we looked at earlier, they were growing at 19%, and they're tiny compared to this. Or what was the other company we looked at? I already forgot, but this is making the point. They're massive. They're still growing at these rates, and they drive profit. And look at this cash flow, $54 billion of cash flow. So they have this network. Nobody even comes close to the number of monthly active users. 4 billion people log into a Meta app every month and use whatever app, Facebook, Instagram, WhatsApp. So that network power is so big. That's their moat, is that they are installed on so many phones. They're used by so many people. You think about families that are staying in touch with one another on Facebook. They're not going to move on to another platform. They're going to stick around. So they have a strong, strong moat. So when we think about a business like that, there's only one, and I put them in the green. These are the most valuable, desirable businesses that I can buy because they have a really strong barrier of entry moat. They're not going to get replaced. They're really profitable. They make lots of free cash flow. They have everything I'm looking for in a business. And it's important to always buy at a discount. In addition to all those things, they're in the green, buy them at a discount. Okay. Now let's talk about that energy company, which was Constellation Energy. And they're not going to be in the green. They're going to be outside the green. So Constellation Energy, they sell power. Power's been around, I think, for over 100 years old. The Nicholas Tesla, right? That name in history. He's the one that Thomas Edison did a lot with electricity, but he's the one that he believed in direct current, which is DC, but the transmission of direct current was it took very large wires, very wide wires, and it was just not you couldn't lay down the infrastructure to make that work. But Nikola Tesla developed alternative current, AC, which you can transmit over large distances. So this has been an industry that has been around forever. Meta has been around for 25 years, 20 years. And where I'm going is the longer an industry is around, the more competition, the more alternatives. Constellation has to compete against solar, old school power generating companies, all kinds of different competitors. There's very little profit. There's a lot of regulation they have to follow. There's rules they have to follow on rates, especially to their residential customers. So Constellation's actually in the red for me. Why are they in the red? Well, they don't make a whole lot of money. They don't leave any cash left for the investors. Once you're done, you have to put it back into the business to keep the plant operating, keep it safe. You have to hire a lot of people to run these plants. So they're opposite to where Meta is. So I would be very careful. I almost never buy any company in the red because they're just undesirable businesses. If they get caught up in a story, investors get carried away. Next thing you know, they're buying a power company and believing they're buying a data center company, which is it proved to be a money losing situation for a lot of investors. So that's how I see it, and thought I'd share that with you guys. All right, so that's Constellation Energy. It was a rough ride for a lot of investors. All right, so Blocks for Fun. Good to see you. How are you? Have you had a chance to look into Serve? SERV. And let's see here. Okay. So we're going to look at semiconductor, and I can touch on Micron there. And then we'll move over to Serve. So when we look at semiconductor, so within technology, let me see if this one will give it to me. Yeah, here we go. No. So here's the semiconductor space. It's been a rough ride for these guys. So 1 year change. Let me put a different indicator in here. So market cap, PE. Okay. So the year to date, everything's in red, but you see some really big numbers in here. Like Marvell is down 55%. The company that I started buying into is down 60%. Wow. Where's Micron in here? Here's Micron down 23%. So this is a sector, and this is actually an industry where it's collapsing so bad that I think there's going to be some companies that are sold off far too much. And I think I want to catch that opportunity. The opportunity I'm catching is a lab, but I've looked at Marvell. I think it's discounted now, but not quite as much as a lab. And I'm not excited about Marvell like I'm excited about a lab. A lab does have a proposition in the data center that I think is really attractive. So I'm jumping all over that. The other companies that are measuring up here, like Broadcom, it's going to keep going down, in my opinion. Nvidia's down 30% year to date. It's for the year, it's still up 6%. Amazing. Qualcomm, I own some Qualcomm shares. I think it's discounted. AMD is down. AMD gets discussed a lot on this channel. People like AMD, but I think AMD is pretty much, the industry's moved past AMD. The industry is now being driven by NVIDIA, Broadcom, to a large extent, these smaller players that are coming into spaces that are really important now, like the data center. So I think there's a lot of opportunity here, and I think it's going to keep selling off because the momentum is to the downside. You see these red numbers. Isn't that incredible? We don't have one stock that is, we have one. Sorry, I stand corrected. We have one stock that's up. What's this one all about? So semi-LEDs. So these guys sell light emitting diode chips. 19 million. Oh, this is a tiny company. $19 million market cap. So they just do LEDs. So interesting. Up 47% over the 1 year. Up 80%. They are tiny. $2.33 per share. So I think there is opportunity within semiconductor, and I'm going to keep following semiconductor. I think it's going to be a place to find opportunity. Philippe Pais, thank you. Rough chart indeed. Yeah. Thanks for asking about that. All right, so it'd be great to have you guys join, especially, I've seen some of your names for well over a year coming on the live streams. It'd be great to see your name highlighted as a member. Please consider joining and coming in and being more involved in the community. It'd be great to have you, and I appreciate you considering it. All right, guys. So I wanted to stream just because it was such a rough week, and but I think we could end there. I'll stream again next week, maybe over the weekend. We'll see if I have time. But just a reminder, it was a rough week. There's no if and buts about it. It was a brutal week. And I don't know what's going to happen next week. I don't know if it's going to be worse. I don't know if it's going to lighten up. But I can just tell you that this market will go up at some point. We're down 22.28% on the NASDAQ. Look at the 5-year. It's still up 111%. Stocks will go up in value over time. Good businesses will go up. And these businesses are a necessity. Are people going to stop using Facebook? No, they need it. Google, same. YouTube keeps flourishing. Netflix, nobody's going to cut their Netflix service. Amazon's going to keep getting bigger. And you see some of these small companies that are really creating a lot of value. These businesses are going to continue to get stronger, more profitable. And for a while, I think they're going to be discounted quite well in 2025. So it's about keeping an eye on the long-term wealth creation of the stock market. And we're entering a phase or a time when these stocks are going to be more discounted. And it may take a while waiting around for these stocks to go up again, but owning these great companies, and then once they start going up, it'll be fabulous. It'll be awesome. So we're just beginning, right? In 2022, the NASDAQ went down 34%. We're down 22. So we're quickly getting there. Okay. And in that year, I can point to a couple of companies. I like pointing to Netflix because I think everybody knows Netflix. And in that period of time, these guys got sold off and sold off just aggressively. And then they picked up and just took off. So as we see some of these stocks Like I showed you the semiconductor list, right? They're getting sold off big. Well, at some point, they're going to stop getting sold off and they're going to take off like Netflix because they're good businesses. They're growing, they're making money, free cash. And that's what happens. But we don't know when it's going to start. We don't know if it's going to be 3 months of all this really bad market condition or if it's going to be 12 months. I doubt it's going to be 12 months. It's probably going to be more like a couple months because this has happened so fast. My intuition tells me we got there really fast and we're probably going to go up a little quicker than we did last time. But that's my guess. That's just basically a guess. So that's it, folks. Hang in there. Let's see what next week brings. Hopefully better days ahead. If anything, just some smoother days ahead. I don't know if I can handle another down day by 6% on my portfolio. It is discouraging, I must admit. But go try to figure out how you can create more cash, more dry powder. Start putting a little more money on your 401k, your IRA. Figure out, I'm not going to spend as much money this year. I want to accumulate more cash so I can buy some of these discounted stocks. I'm going to sell some of these bonds. I'm going to sell some of these, low risk assets. I'm going to work a little more, make a few more dollars. Because if I can invest more in 2025, I'm going to build my wealth. And that's what it's about. So that's it. I appreciate it. It was a good week for members of the channel. I appreciate on the stream, we had somebody join, Kevin. Thanks again. And we had 2 other people join today. So we had three members join today, all in all, which I appreciate very much. Thank you so much. All right, everybody, have a nice weekend. Thanks for tuning in.